You're listening to the New Jersey Real Estate Investor Podcast. We talk about all topics related to being a real estate investor in the Garden State, based on our experiences with buying, selling, managing, and building rentals. So together, we can all be better investors. Now, here is your host, Pete Tverdov.
Okay, guys, welcome back to the New Jersey Real Estate Investor Podcast. I'm your host, Pete Tverdov. And today, I have a special guest with me, John Park, who actually has started to partner with me on deals and has helped me a lot. He's a very successful developer in the Middlesex County area, let's call it, New Jersey area. There might be some deals he has not told me about. But anyway, John, welcome.
Hey, thanks, Pete. It's been great partnering with you. It's funny that you describe me as a successful developer so far because everything seems like it's going wrong, but it's a tough interest rate environment. So let's put it like that. But it's been great working with you. And we have a couple of deals going now, right? Two?
Yep. So we're not going to talk about the other one because I'm superstitious. That's got to... If that, God willing, if that gets approved, we will bring it on the show to talk about it. But so today we're going to talk about a deal in Franklin Lakes, New Jersey. It's a syndicate opportunity. We've reached out to investors about this. So I'm going to walk through the audience on this, and I thought it'd just be a really good opportunity to talk through it and give those of you listening and kind of an inside look on how one of these deals works, because a syndicate, basically, in a nutshell, is when you bring several general partners together, and then you also have limited partners, investors, and that kind of helps get the deal over the finish line. So I might be a little hazy on the details, but this is a 52 unit, 52 unit apartment building in Franklin Lakes, New Jersey. Those of you who are not familiar with that area, it is in northern Jersey in Bergen County. It's probably one of the highest income areas in New Jersey. The median household income in Franklin Lakes is $270,000. So you have to be doing pretty well to live there. So I would classify that as an A-class area. And then the building itself was built in 2022. Brand new. So I would classify that as an A-class building.
I would say A+ even.
A+, yeah. So you got an A+ location with an A+ building. So that's, for me, what kind of made it attractive, because you don't see that, especially in New Jersey. What I see a lot, and you could chime in, is maybe it's new construction, but it's in not A-class areas for sure.
So for example, Brentwood, right? I asked you to property manage that. You spurned me. That's an A-class building, I would say. That's an A-class building, I would say, but the tenants are not A-class tenants. So,
right.
There's always collections issues and stuff like that. Franklin Lakes, the reason why we're so driven to it, like Pete said, it's a $270K average median income. Most of the people there they sold their house, they retired, they just want to stay in the area, and they're never not going to pay rent. You're going to have 100% collections. It's going to be the easiest property management gig that Pete will probably ever encounter. So
that's how you guys know he's never managed a property a day in his life.
So other things about Franklin Lakes, the reason why we find it so geographically appealing is that they have major highways, I-287 goes right there, Route 208 is right there. Great local spots like Franklin Crossing, Franklin Lakes Town Square. It's also got pretty low property taxes, and the school system is great.
So what's funny? My father-in-law is originally from up in that area, and he was explaining to me, basically the way he said it, he's I don't know how they do it, Pete. He's but their property taxes relative to the home values are really low.
Yeah, I think it's 0.5% of their home values. So
anyway, there's several things as you guys are listening that are attractive, make it attractive. And this is something that I hate to bring this guy's name up, but this is a deal that Grant Cardone talks about, where he that guy likes investing in A-class buildings all over the country. Now, given that it's A-class tenant, A-class building, the projected return is a little bit on the lower end versus something that needs value add or in in a rougher area. So why don't we talk a little bit about that?
Yeah, let's talk about the strategy. So, this is what we call in the syndication world a core product, right? We're buying the product because it's already good. There's really nothing to improve. We may be slightly getting it for cheaper than what a market rate apartment would go for at this place. We're using something called cap rates to determine the value. And usually a building like this that was selling 2-3 years after it's been built, would sell at like a 5.25 cap rate. So, if you want to explain to them what cap rate is.
Yeah, I mean, just in a nutshell, so the cap rate, for those of you who don't know, is basically like if you paid cash for the building, what your rate of return would be. And John's right. Most new construction buildings, the cap rate, it starts with a 5.
Yep.
Like even today, it starts with a 5. And so the cap rate on this one, I think, it starts with a 6, correct?
Yeah, so we locked in the purchase price based on their net operating income at like 6.15%. So we're getting it for a good deal. And I can go into more why we're getting it for a good deal. But like the price was very attractive, right? So that was part of our combination. And we're assuming that like we own it, we manage it for like 3 to 5 years. And in the 5th year, we could potentially sell it for a 5.5 cap rate or 5.22 cap rate 5 years from now, right? Because there's really nothing to do. We just need to keep the upkeep. That's Pete's job. Keep it nice, keep the tenants happy. And then, the rents keep on growing up consistently for the next 5 years. We're thinking maybe like 2 to 4% on certain years. The rents will increase and your NOI keeps on increasing. And then, on the 5th year, we can either somewhere in the 3rd year, we can refinance, and the 5th year, we can sell the building. So that's sort of like the strategy. And because we're getting it for such a good cap rate, and because, there are some kind of financial instruments out there, the thrust of the thesis behind why we're buying it is we want to generate a certain cash-on-cash return for investors. So in this specific project, we're trying to generate anywhere between a 6% to 8% cash-on-cash return for investors. That means every month on an annualized basis, where if you invested $100,000 into this project, we'd be giving you like $6,000 annualized over the life, and you'll just consistently get it, and you can rely on that income. And that's why an A+ tenant pool is so important, because they're always going to pay rent, and there's never going to be an issue of like, there's not going to be any hiccups in collections and things like that.
Yeah, so I think of real estate investments like that, like equivalent to like a bond or just like a very solid stock.
Mm-hmm.
It's not a growth stock. I mean, it'll grow.
Yeah. Slight appreciation.
Yeah. It'll appreciate, but it's not, you're not buying NVIDIA or Palantir or something like that.
You're basically buying, I guess the best stock to compare this to is like Procter & Gamble. You're buying Procter & Gamble. They have consistent dividends, and they're going to keep on
the increase. Yeah.
Yeah. And it's, slight appreciation over time, right?
Yep.
That's sort of like the thesis behind the financial engineering, but because it's already like there's really no value add for us, we're buying it slightly in distress.
Yep.
The IRR returns, the internal rate of return for a project like this would be like, we're trying to aim for like a 12 to 14% IRR return for investors. And that assumes that we can either refinance the property well in 3 years, or we can sell the property in 3 to 5 years.
Pete Tverdov here. If you are a high-paid professional making more than $300,000 a year and you are looking to build wealth and to diversify your investing portfolio, me and my team at Tverdov Housing can help you build a real estate portfolio and earn passive income owning rental property here in New Jersey. We could help you find the property, help renovate it, help manage it, and even help you sell it and buy something bigger and better one day. If you want to build wealth, get some passive income, and have more financial freedom than ever before, contact us today.
What I like about it is you're entering this deal, you're going with the current of where the interest rates are going. So like you're not entering this deal as they're raising rates. Mm-hmm. You're entering this deal as they're cutting rates. They as of this taping, the Fed again just announced they were cutting yesterday.
Yeah.
And I actually really dove in because I am kind of like a nerd with this stuff. So they also announced, I don't know if you heard, that they're basically ending quantitative tightening.
Yep.
Okay. And so for those of you who don't really understand what that is. Basically, what's going to happen is they are now going to start buying more short-term debt. Mm-hmm. And in the short term, I'd say in the next 3 to 6 months, that it will actually affect 30-year mortgage rates. And I think it'll make them a little more elevated. So even though they cut, I don't think the 30 years is going down. But I think long-term, in the next 2 to 3 years, it's a very good thing for rates. And more importantly, it's a very good thing for short-term rates. So if you're doing a deal like this, you're not getting a 30-year mortgage anyway, right? So why don't we talk about that a little bit? So how the banks price mortgages?
Yeah. So I mean, Pete's right. Actually, one of the things that to note from yesterday's easing is that as soon as as soon as Jerome Powell cut rates, and then he opened his mouth and said, like the next cut is not 100% certain and stuff like that, that bastard. But, the quantitative tightening is going to be important too. Actually, treasury rates, so like what Pete and I look at when we're looking to get mortgages and perm refis and construction loans even, is the 5-year treasury, the 7-year treasury, and the 10-year treasury. Because all the loans that you get for perm refis for multifamily buildings are based on those 3 rates. So, and then it's like, if you want a 5-year loan, you base it on the 5-year treasury. And it's usually a spread over the 5-year treasury. So I'm looking at rates today in today's market for like 150 points over 5-year treasury where it is.
Oh my God, I thought it was like 200, dude.
No, it's like 160 right now.
I asked the Grok AI last night, like what the 5-year was. I think it was like 3.75 or something like that.
Yeah, so it's 3.7. So it was 3.6. It was going on to 3.5, and then Jerome Powell said that he may not cut rates in December, and then it went up to 3.7, which drives everyone crazy.
But even if it's 3.7, let's call it 3.75, right? 150. That's almost a mortgage of like 5.25.
Yeah, so that's if you're locking in for 5 years, and the reason why you're getting those tighter spreads, and if you lock in for a 10-year loan, right, like a 10-year Fannie Freddie loan, or even a HUD loan right now, you could actually get rates as close as 110 over, or spreads as tight as 110 over 10-year treasury.
No, so that's for HUD loans?
Yeah, for HUD loans or anything any 10-year product out there
kidding.
Right now. Yeah. So right now, banks are feeling that the rates are going to come down, and they're trying to pressure people into locking in for 10 years now because they think that rates are going to go lower. That's what sort of that pricing spread shows.
Oh, interesting. Because that was a lot for maybe several of you listening, because it was a lot for me, honestly. But to dumb it down to a football player's terminology, basically it sounds like the 5-year and the 10-year are almost the same rate.
No, it's like, so 5-year is, actually it is almost the same.
That's what I'm saying,
It's the same rate, yeah.
So that's interesting. But so that's nice, guys, because if you think about it, you're buying an A-class property in an A-class town at a little over 6 cap. You're locking in a pretty good rate. Yep. And you're also going into a tailwind of
dropping inflation.
Rates where like they're trending lower. Inflation has been pretty smooth the last 18 months. Right, knock on wood. So that's all good stuff. So the play with this is in 3 to 5 years. Obviously, nobody knows, but the play is even if rents only go up 2%, that means the building will increase in value. As long as rents go up, the building increases in value. Period.
Yeah. So just to give a quick background on the building, it is a 52-unit property. Like Pete said, is like amazing resort-style amenities, right? Like we're talking golf simulator, state-of-the-art gym, movie room, event lounge, outdoor patios, fire pits, and BBQs. It's truly a place where people want to live. We're talking about A+ level finishes, right? Like, so not the stuff that Pete puts in his houses, but in-unit washer dryers, custom closets, quartz waterfall counters, like stainless steel appliances.
Yeah, it's nice.
It's really, really nice, like really high-end product. There is an affordable piece to it. So I think 20% of the units are affordable, but it is like A++ prop.
Let me touch on that for a minute, because people often get that confused and they'll say, oh, so there's Section 8. Like, no. It's not Section 8. So affordable is completely different from Section 8, guys, just to understand. And affordable means like affordable. It is very cheap, but it's also very difficult to qualify for something like that. And you work with like a completely separate agency where they handle like the affordable housing. And if you think about it, there's laws in New Jersey that were passed long ago where every town needs to have some sort of affordable units required, especially when they're building a building as large as that.
Yeah, so I can give like a quick background on it. I was once upon a time a corporate lawyer, so I sort of understand the law around this. There was basically the state basically said that it was a matter of public policy that each town in New Jersey meets their affordable housing quota, because I think the price to afford an apartment these days, according to their studies, is like you need to be making like $35 an hour to be able to afford to live somewhere like a human being, basically. That was their...
On your own.
That was their thing. So this agency created like all these affordable housing requirements for each town, right? And then all the towns, especially towns like Princeton, Basking Ridge, Franklin Lakes, they all fought it. They were like, no, we don't want affordable housing in our town. We want to keep the home values higher. And you got a lot of NIMBYs showing up and protesting it. So it went all the way back to the Supreme Court. So this is like decades in the making, right? It went all the way back to the Supreme Court, and the Supreme Court of New Jersey ruled that no, you have to create affordable housing. If you don't create affordable housing, we're going to start fining the townships that don't have it. And it's just, you're throwing taxpayer money to litigation fees. So they came back, they required every town to have more affordable housing. Some towns are still fighting it, or they're fighting where it's going to be, in their towns and located. And it's actually created this pocket of opportunity for developers to go into towns like Franklin Lakes, Princeton, Basking Ridge, and build multifamily in places that like you would never think that they would ever be allowed to build multifamily. And this is sort of one product like that, right? So they gave a concession of 20% affordable, but we're going to build 52 units. And there's a lot actually, and this is going to be, come into factoring into should we go forward with this deal or not? But like there's a lot of these products coming up everywhere, right? So it was that's sort of like the affordable housing, but like you're still paying like $1,000 per unit in this area, and that's like the lowest end affordable, right? And you're getting like you get slightly inferior quality, right? They don't use nicer finishes for the affordable units.
Units are a little smaller.
Yeah, units are a little smaller. You still get access to amenities, but you might have to pay for it for the amenity fee and things like that. So it's not like the end of the world, but it does affect. When we're underwriting these development deals, it does affect like the IRR returns because it's like
because of that.
Yeah, it's like basically you're getting almost nothing.
But your underwriting includes that.
Yeah, our underwriting would include like how much we're actually getting for this deal.
All right, so let's talk about the property taxes on something like this.
Okay,
because I'm sure that's a question people have. So, because a question I often get from clients when they're buying obviously a much smaller asset, but they'll say, hey, Pete, if I buy this, are the property taxes going to increase? And the answer is that kind of depends on the town. They usually don't do that, but like larger buildings, they may. So like has that been included in the underwriting?
Of course. So we actually, and you've met my Chad, he underwrote it extremely conservatively.
Your quantitative?
Right? my quant. So, he underwrote it extremely conservatively. He actually has taxes where currently the taxes on this building is like $315,000 a year. He has it going up to like $417,000, and we're still even with that rise, and we padded the property management fee for Pete a little bit because he needs 4% instead of 3%.
Yeah,
and then we just assume on when we underwrite this, we're assuming like property expenses are going to rise just all around the board, like by 2 to 3% every year, regardless of whether it does or not. That's just the way we underwrite it to be safe. We also underwrote it so that the rents are increasing at 3% every year, which is, I think, right down the middle of like 4%, which is on a good market, 4 or 5%. And then like, if we see a lot of units come online, or if there's some kind of like, recession, we would think like, rent increases would drop to like 1 or 2%, right? So that's sort of the underlying assumptions when we underwrote this deal. Just to give a couple more metrics about the deal, like I guess we're buying it at a $29,300,000 purchase price. There are closing costs in there. We're looking to raise $11 million. We're looking to raise $11 million to close the deal. We're getting a $20 million bridge loan. So the bridge loan is a really important factor that I'll come back to. And we're planning to hold it for 2 to 5 years, right? And we have banks committed to financing it for $20 million. And the bridge price that we're getting is around SOFR plus 180.
Okay, so let's stop right there. Explain to everyone, like in simple terms, like what a bridge loan is, and then SOFR plus 180, so they could just understand that.
Sure. Bridge loans are basically like the banks know that you're going to buy it, but you don't want to lock into like a long-term loan. So they're giving you something called like a balance sheet loan based on like, it's like the bank's own money that they're giving you, and the collateral is the property for the next 2 plus 1 year, so that you can basically wait for a favorable time to refinance the property into a better interest rate environment. Right. Or if the seller needs to close quickly, the bank will give you a bridge. And then after they give you a bridge, they'll like convert your bridge loan into more conventional financing. So that's Fannie, Freddie, or HUD.
So is it fair to say a bridge loan is like a short-term loan?
Short-term as in like 2 to 3 years, right? And then it's an adjustable rate loan or a variable rate loan, meaning like wherever SOFR is where the rate of interest is going to be plus the spread. So the spread here is 180 points. SOFR is, the secured overnight federal lending rate. And that's currently at when we actually locked this deal up, it was, I think, at 4.5%. Because of all the cuts that's happened since. It's at like a 3.75 to 4% right now. So we're getting a loan that's effectively like, let's say 3.75 plus 180.
Right. So you're looking at like 5.5 to 5.75, something like that.
Exactly.
Something in that range.
Yeah. And then
for 2 to 3 years.
For 2 to 3
years. And then
years.
after 2 or 3 years, then what happens?
So after 2 to 3 years, you need to have an exit. So whether you sell the building and because the rate, the market gets really good, or you convert into a perm refi. The other thing about bridge loans is that they're typically interest only. So you're not paying any amortization. You're not paying any amortization throughout the course of the loan.
But that helps you with cash flow.
Exactly.
Right. So to pay out the limited partners or investors on the loan, and this is all like kind of like textbook stuff with syndications. So if you're if you're listening and wrapping this together, basically, guys, this is a play on, you could almost argue like obviously the economy, but like interest rates, right? Yep. It's like in 2 to 3 years, like if the rates suddenly start cooking, right? And like I don't know. Again, I base everything off the 30-year mortgage, but 30-year mortgage is down like 100 basis points, and the real estate market's now heating up again.
Yep.
Like you'll be in a very good spot to sell this building. If they don't, and it stays how it is right now, then you own an A-class asset in an A-class town that's still spitting out good cash flow and good returns and appreciation. So it's a very safe play from my perspective.
Procter and Gamble, or we could call this the Franklin Lakes bond, right?
So that's anyway, that's kind of dumbing it down. Now, from a property management perspective, so what I've learned about syndications, and you could correct me if I'm wrong, but this is my view. I think obviously you make money when you buy. I get all that, but like I think your management can make you or break you. Yep. on deals, right? So your management is very important. So, like John originally came to me to manage it. It was like, and I was like, yeah, I do think we can manage this. I think we want to manage this because he's right. Like he came in like 2 years ago for like 90 units. And I was like, no, I don't want to manage that. And then I actually had buyer's remorse. But let me tell you why I like it from a management perspective, because I do get people who come to me from time to time. Hey, I've got X number of units. It's smaller multifamilies, but still like a pretty large multifamily building. And I'll be like, okay, who does who takes out the trash? Like, oh, a guy, like a man in a van. Okay, great. Does this building have a doorman? No. Okay. Who takes care of the lawn? Oh, Chuck in a truck. Okay, great. What about fire sprinkler? Fire what? And then like I go down the list with everything, and they don't have those parts in place. So with this building, I went through this with John, and I'm probably forgetting stuff, but like they have a company that services the elevator. Yep. They have a company that services the fire alarms and fire sprinklers. They have a snow removal company. They have a gardener who basically, who waters all the flowers and trims all the shrubs. They do have a doorman or door lady,
concierge,
I guess.
Concierge.
Like concierge, right? Like somebody sitting there on site, which means someone is going to be looking at that site daily, right? They do have trash already set up.
I think they have a cleaning crew too already.
Yes, they have the cleaning crew. That's very important too. Yeah. So like they have all these pieces set up. So all they need is a manager to manage it all, make sure all those vendors get paid, make sure the rent is collected, take care of the financials, and then do the apartment turns and the leasing. So that was assigned to me like it's kind of like a well-oiled machine. That's good because a lot of these deals, your management company has to go and look for all those people.
Yep.
Or, I guess because the deal's so thin, the operators will get creative and be like, well, we could do this in-house, we could do that in-house. And like, it kind of mucks up the water a little bit. So for me, just purely as a property management company owner, that was very attractive to me because it was like, okay, all the pieces are in place here to have success. So that's what I liked about it from a management perspective.
Yeah, I'm just trying to make your life easier, Pete.
Well, yeah, I appreciate it.
Yeah, so everything Pete just mentioned, that's like basically on the expense line, right? So we have gross rental revenue, then everything that Pete just mentioned it goes out as operating expenses. Then you have to pay insurance and property taxes, and then that's where we get our net operating income, and that's what drives the cap rate. That's what drives what kind of financing that we're going to get for a property like this. And then the cash flow that Pete was talking about is after that, and then after we pay all the expenses, so that's like net operating income. Then we pay the debt service, and then whatever's left after paying debt service is what we call cash flow.
Right. So because this was a question I know people have. Let's talk about like the waterfall structure a little bit, and then if you want, we could talk about like the fee structure a little bit.
Yeah. Sure.
So what's the waterfall structure on this?
So the waterfall structure is so when we have syndications like this, there's available cash basically every month, and then there's two things like regular operating cash flow, right? Every month after we paid debt service, this project is anticipated to have around $800,000 of cash flow, just if we just operate normally with all the debt that we have, right? After that, so we basically say, hey, the first hurdle of the waterfall is we want to hit our investors with at least a 6% preferred rate of return. So if you invested $100,000 in, you have to at least make 6% on that before the general partners. So that'd be you, me and you, Pete, right? We wouldn't be able to have any of the cash flow until we're hitting at least a 6% cash on cash. But it's not just 6% cash on cash. We have to get all our investors back 6% cash on cash and all their initial capital contribution back before we eat anything as a general partner. That's sort of like what we call the promote, right? And we don't normally get any promote or equity waterfall unless there's a massive, we call it cash event, right? Like, so that's at refinance or a sale, right? So typically we won't me and Pete as sponsors and general partners won't make money until we either have a really good refi or a really good, a really good sale. And that the whole theory is me and Pete have to perform and really return all the investors back and hit 6% on your money as a preferred rate of return before we share any of the profits of the building, right? So after we hit, like, let's say 3 years from now, we sell this building for like $35 million and we bought it for 30, right? We'll have actually a $5 million upside. The first thing we do with that money is pay you. So we raise $10 million for the sake of simplicity. We raise $10 million. We give back $600,000. Yes, we give back $600,000 to the investors first. And this is accruing, by the way. So if it takes us 3 years, it's 6% plus 6% plus 6%, right? We give all of that back first. Second, we give all your money back. And then, so that's like, let's say $600,000. $600,000, we give the $10 million back, and there's a $5 million upside. So starting from like after this, between 6% to 10% IRR, that's when Pete and I start getting something called a promote, right? And after we hit 6%, we're basically saying, hey, every dollar after $600,000, you have to share 30-70 with us until 10% IRR, which is the second hurdle.
And so they get 70, we get 30.
Exactly. Right. They get 70, we get 30. Correct. Exactly. So for every $1,000, we're getting 300.
Right. And then I believe it scales up. Like,
so after we generate a 10% IRR, we split everything 50-50. And that's sort of the thing. And those models are, that waterfall structure, everyone does it differently. Some people are 80-20, some people, and up to 10% or 12%. It's really up to the investors and what the market's looking to get. After we do that equity waterfall with our projections, and that's us assuming we're selling at a 5.2% cap rate in 5 years, we're saying, hey, you're looking at a 13% IRR return on a project that was very stable, almost no risk. So that's why we were more aggressive with the waterfall for the GPs at that point.
And then what about like typical fees with a syndication, if we could dive into that a little bit?
Yeah, so typical syndication fees, let's see, there's something called an acquisition fee. So that's for that's for sponsors that are finding the deal, sourcing the deal, negotiating it to a good price, executing on that deal, getting the financing for that deal and getting it closed. And usually that's 2% of the purchase price. And that's negotiable too, but it's usually the market standard is 2%. There's also placement fees. So typically when we're looking to raise money and we can't call everyone in our network and we need to raise more money, we go to like these professional capital raisers. They'll charge a fee anywhere between 2 to 4% on the total dollar raised. So if I go to a placement agent, usually these are broker dealers. They have like broker dealer licenses and stuff like that. They're selling a security in this property, right? They will charge you like, if they bring $1 million, they want to get at least 2% on that $1 million. So that's a fee that we have to pay to those capital raisers, right? There's a refinancing, we call a loan closing fee. So that's usually goes to like the broker who brings a loan, and their job is to get you the most attractive, like look at all the lending options and see who's willing to give the best loan and place that loan, and they get paid at closing when we get the actual loan to close this. There's something, there's a property management fee that goes to Pete for running the property that's paid on an annual basis. There's also something called an asset management fee. So there's someone that has to, after Pete runs the properties, gives us a report of how much money's come in, someone has to dissect that, keep an eye on whether Pete's, charging too much for cleaning or too little for cleaning. Like if he's charging too much for leasing, they're just watching all the numbers.
Sure, yeah.
And then they prepare a report on a monthly or quarterly basis, and they ensure that the distributions are paid from the property. They're ensuring that the taxes are filed, the K-1s are filed and stuff like that. That's also another thing we should talk about is depreciation. And, that's sort of what an asset manager does. That they usually charge like 1% to 2%, even 3% on the asset, the equity that's in the property. So in this case, if we're raising $10 to $11 million, they're charging 2% per year on that equity.
Yeah. So when, I guess when an offering memorandum is circulated to investors, like those fees are broken down, right? It's like in this deal, like we've had those fees explained to people. Again, John's just kind of giving you guys like generalities. It kind of depends on the deal and I guess the GPs. But that's kind of like an explanation of the fees. Now,
there's also a couple more fees. There's a disposition fee. So when you actually make the sale, there's a fee that goes to the general partner or whoever spearheading the sale. So if you're able to lock in a great price, like we want to reward the person who finds the buyer to convince them to buy this property. So
right.
There's sometimes a refinancing fee. So like, if we need to refinance that bridge loan, that we may have to cut out a point or half a point to pay the broker that helps get the refinance done.
Right, to pay the broker.
Exactly.
Yeah.
Sometimes if there's, broker takes less, the GP can take a little bit more. There's play in the joints.
Yep. Understood. Okay. Now, the other attractive thing with syndicates, and I've known this for a long time, is the tax advantages of them, which I touched on in a previous podcast about 100% bonus depreciation. And if you have not listened to that, you really need to, because you're just doing yourself a disservice if you're a professional real estate investor and you don't do that. But with a building of this size, and really any building, like an operator is going to do a cost seg study, which I touched on in that episode. But basically, it's when a company comes out, they do a humongous evaluation of the building, very thorough, take lots of photos, they break everything down, and they say, okay, this building could be depreciated over, actually commercial, I think is like almost 40 years, something like that.
Yeah.
So I'm making this is not an exact number, guys, so don't take it as gospel, but like normally, let's say the building could be depreciated over nearly 40 years. Well, with cost seg analysis, you could front load that depreciation and get a lot of it depreciated in year one.
Mm-hmm.
So a rough calculation that we did was for every $250,000 that somebody invests, and John, correct me if I'm wrong, but I believe the depreciation was between like 100 and like 125,000.
So 105 to 150,000.
Okay,
in the first year of depreciation.
100 to 150,000. So which means, like, if you're, and this is where it gets a little confusing. If you make active income, basically, if you're not a professional real estate investor, right? You're a lawyer, you're a doctor. You don't have passive income, or excuse me, you have active income, but not passive. This depreciation you could write off versus your passive income.
Yep.
So if you've got other real estate that you own, if you do well in the stock market, you get dividend income, that 100 to 150 grand you could write off against that income. And obviously you have to check with your CPA on this. I'm not a CPA, but that's the play that people do, and that's why in a lot of syndicates you get high net worth individuals or high income individuals, because it's just as much of a return on investment as it is a tax play.
Yep.
So someone out there listening is like, oh, well, 11%, 12%, like I could just, this is a devil's advocate, I could just put that in QQQ or VOO, and get 11, 12, 15%. So like, why wouldn't I do that, Pete? Why wouldn't I do that, John? And my counter argument to that would be like, well, you can't do a cost seg in year one on QQQ. So like, you also have to factor that into it as well. And then, like QQQ, yes, it gives you, actually it doesn't give you a dividend. What the hell am I talking about? That's just the appreciation.
Capital appreciation.
Yeah, that's just the appreciation. So like, that was a terrible example. That's why
I was like,
that's why everything I do is real estate investing. I don't do much stock. But the point I'm making is it's very difficult to match the returns of real estate when you include the tax advantages with it.
Yeah. So I guess the best way to describe it is, hey, let's say you're an active real estate. You're not an active real estate investor. You're a passive real estate investor, and you're holding like 1,000 shares of Apple, which generates a nice dividend, which is passive income, right? And you have an investment in this, and we're giving you passive income at the tune of 6 to 7% cash on cash on this project, right? The first year, this project is projected to generate around $5 to $7 million in depreciation. So that means that, when I give K1s to all the investors, they're going to all get, even though I've given them 6% or 7% on their money, they're going to get a negative K1 to the tune of, like Pete said, like if you invested $250,000, which is the minimum, you're going to get around like $150,000 minus your $6,000 that you made or something like that. Right. So you're going to have like negative $100,000 to play around with in your tax return that year. You can use that to offset your Apple stock, your Apple stock dividends, because that was passive income. If you have other rental properties, you can use that to offset that rental income. So, but even if you didn't have that income, what we're promising you is you can at least depreciate, you can at least offset the cash on cash return you got from this project. So, so the benefits of investing in something like this versus money markets, right? Where money markets are offering like 3 to 4% right now with like virtually no risk. This is giving there's still risk in this because it is like someone might not pay rent, which is like a very minimal risk or something. And then the performance of this project doesn't work out. You're still going to get 6 to 7% post taxes. So what we're promising, if you do put it in money markets, you get 4% and you pay taxes on that 4%. Here, we're giving you 6 to 7% and you're not paying taxes on that because of the depreciation.
Yeah. That's what makes that stuff attractive. So,
if there's like one thing I would add to this too is like, I understand that like if you've invested in stocks for the last 3 years in the American economy, right? Like, and you put it in stuff like Nvidia, you're probably looking at like 50% capital gains every year or something like that.
I don't even know, dude. Nvidia is like 100%. Dude, my daughter, I bought her. One of my buddies listens to this podcast. He's a godfather of one of my kids, and he told me, he's like, buy Palantir. This was like 7 years ago, dude.
Yeah, I bought Palantir.
Or 5-6 years ago, something like that.
While I was in law school, I bought Palantir.
Yeah, and like, so I literally took everyone's money from like the baptism. I was like, whatever, I'm just putting it all in Palantir. Yeah. Dude, she's up like 1,200%. It's like absurd, right? Yeah. It's like people who have stocks like that, yes, you obviously have a very heavy tax to pay. So my daughter, if it continues, one day she'll have to pay a lot of tax, but she'll have made a lot of money. So
she'll make the money.
She could thank her God.
Unless she puts it into an OZ, and then she can actually walk away from.
Oh my God, that's right. I should do a podcast on that. We're not going down that road. We're not going down that road.
No. So the theory, the argument is, hey, right now, if you look at the earnings of stocks, and this is sort of an argument for why you should put money in a project like Franklin Lakes, the Franklin Lakes bond, right? Is if you look at stocks right now, a lot of investors are nervous because, the stocks are trading at crazy multiples. I think I pulled out a Palantir this year, actually. It's trading at 600 times earnings. Like that means Palantir would have to, for the next 10 years, they would have to have a perfect record. And then investors could probably just break even.
That's how the stock market is, though, man. Like it's always trading on like what could happen or what's supposed to happen, not like what. Like if real estate traded that way, like every house would be worth like $2 million.
Yeah,
I've never understood it. Yeah, I know.
It's so like like if you're looking at the market and you're not nervous. I mean, if you're not looking at the stock market and you're not nervous, if you're looking at the general stock market, the only stocks that are actually doing well are AI stocks. This is a complete AI fueled people would argue, I don't want to say it, but a bubble, right? That's potentially building in the stock market. And, we're actually rewarding companies for spending money, committing to spend like billions of dollars on building these data centers and stuff like that. So I think the estimate was like they would need to, these companies would have to make like $2 trillion by 2030 in revenue in order to justify the expense. So
they might, dude.
they might, but it's still it's still a huge bet, right? So if you want to hedge against it, this is sort of like the perfect hedge, right? Like this is going to give you consistent cash flow. It's going to give you a nice, not an astronomical IRR, but a nice IRR with basically no risk. We're just running it exactly as is, right? And you get all these tax advantages with it. So it's like a nice hedge in your portfolio.
All right. So let me try to wrap this up. So at this point, the deal is under contract. We're in due diligence, and I think as of now, we're going to ask for an extension.
Yes.
Right. So let's talk about that, and then just kind of like final thoughts on the deal.
Let me just add one more thing about the deal that's interesting. We're getting a bridge loan that's SOFR plus 180, right? Like that's sort of what the loan that we're going to get. SOFR's trading currently at 3.75%. We're going to buy something called an interest rate cap to basically bring our debt service down to 4.5% per month. That gives,
for those 2 or 3 years.
Exactly. So we're basically we're paying for it up front, but we're basically expanding the cash flow that the project has. And that's how we're hitting 6 to 7% cash on cash. That interest rate cap is also one of those closing costs that we have to pay for when we close the deal and close the loan. So that's how we're generating that high cash on cash return. Because if you just, we're just listening to this podcast and you're like, wait, they're paying the cap rate is 6.15, the debt service is like 5.5. How are they hitting like a 6% cash on cash?
Right.
That's how, that's sort of like the financial engineering that took place to generate that 6-7% cash on cash. So we're right now, me and Pete are like thinking, hey, do we go forward with this deal or not? Like we had a 45-day due diligence period. The lender still hasn't given me a full commitment of whether they're going to fund the loan. I don't think we have, like, out of the $11 million, we probably only have like $4 or $5 million fully committed.
Yeah,
we need to raise
half.
another $6 million, $7 million. So, and in order to go forward with this deal, I have to put like, $290,000 hard, meaning I can't, like, once I go hard and I don't close, that means I lose that $290. So I'm at a point where I'm like, hey, I can blame the bank for this, but I'm like saying, hey, the bank hasn't given me a full commitment letter yet. Like I could go down this rodeo with the bank, do all the appraisals, engineering, and then they could spur me at the altar of the closing.
That's true. Yeah.
So that's why I'm like, I'm nervous. I don't want to move forward with this deal unless I have a full commitment letter from the bank. And that's my like sort of reason to bow out of this deal. So that's why, like, I asked the seller, I need 30 days. I need 30 more days. And, the seller could come back and be like, no, I don't want to. I want to put this back on the market. And, he could, and more power to him. We'll walk away at that point. Or, he'll give us the 30 days. And then that will get me thinking, oh, maybe I'm overpaying for this property. So.
Well, do we want to touch on the other thing with like the other units come to market as well?
Yeah. So when we did a market study on this, and this is sort of came to light, we haven't really thought about it until until it came time to think about everything before we went hard. There's another 500 units that's been approved half a mile away, and we're concerned that once that unit gets built, like you're going to either face higher vacancies because people are moving out at that point to go into the nicer 500 unit apartment, or you're going to not. That apartment, while they're stabilizing, will do something called rent concessions and like all kinds of like gifts in order to steal away all the tenants. So we'll be competing with that in 2 to 3 years from now. And do we really want to be competing with something like that? This might be all gravy for 2 to 3 years, but once that building gets built, and then they're trying to sell their building and we're trying to sell our building, who are like, if you're an institutional buyer that can offer like a 5.25 cap rate, would you buy our building, which is going to be 8 years old at that time, or are you going to buy this brand new building? So that's
an institutional buyer is going to buy the 500 units. 500 units is like insane. Nuts, man. Like, and like, I believe the rents or the projected rents for that building are going to be lower than ours, but like, I don't like.
But that's also scary too. It's like their rents is going to be a brand new building. They're projected to have lower rents than us, and then so the people that are living in this is like I can go to almost an equivalently nice, fresh building and pay less rent. And why would I stay here and keep on paying keep on paying? I think it's like the average here is like
over $4,000. Yeah,
$4,000 per unit. So that's sort of like a reason for pause.
And sorry to cut you off. The average is $4,000. That's because there's like eight units that are like $1,000 of affordable, guys. The real average rent, if you cut out the affordable, is like almost $6,000. It's like $5,500 or $6,000. It's a lot. And
the beauty of this building is 100% full, and people are actually paying it. So
yeah, as you guys can see, there's a lot that goes into these deals. It's not just doing some back of the napkin math. Like, oh, sure, let's buy it. There's a lot that goes into it, and then even as we're raising money, which we're in the process of doing right now, like we're still doing due diligence. And then if we feel like, this isn't going to pass the sniff test, then we'll kill it and move on to something else. That's
exactly it. Yeah. Don't love a deal too much that you have to don't make a deal decision on this based on emotion. But then again, the seller might come back and then be like, hey, what cap rate do you want? And they may lower the price, and that would get us to reevaluate our model. Right. So
yeah, I'm going to leave it at that. But I think this was a great idea. I wish I came up with it. Someone else, actually, the real estate mastermind I was at last week, it's called Collective Genius. It's really awesome, dude. I was talking to some people about this deal, and like other podcasts do this. They just talk about the deals, and some deals work, some deals don't, and they just talk through it. But it's great for the listeners to hear, because I think you guys, if you're still listening at this point, you could hear like how much analysis goes into it. And at the end of the day, like I'm a big believer, like if you're taking other people's money, like you have to take care of them. Like even if me personally, like if I don't make $1 on the deal, like they have to be taken care of. And I'm a big believer in that. So
yeah, I mean, just to touch on that, this is like my second syndication officially, but I've done multiple development deals. I've had deals go really well, but I've also had deals just completely flop. And, like I'm going out of pocket to make sure that the investor, gets their money back and gets even a certain amount of return, because, they've had the money invested with us. So it's just, I think that's why I like working with Pete. He has the same mindset, and that's like our investment core focus.
So what I'm going to say to wrap up the podcast is, if you are interested in deals like this, or, kind of seeing what we're up to here at Tverdov, reach out to me on Instagram, go on our website, tverdovhousing.com, Instagram, Pete Does Real Estate, find a way to reach me. And, I can put you on a mailing list. You can kind of see what we're up to, because this is one deal we're talking about now. I'm really hoping and praying in a month, guys, I could bring you another deal, because if it gets approved, we're building that whether you want to invest or not. Like that's getting built. It's getting developed. That one I'm equally excited about. And, hopefully in the future we have a couple of these a year. So I'm going to leave it at that. John, thanks for coming on. And guys, thank you for listening.
Thanks for listening to the New Jersey Real Estate Investor Podcast. Make sure to subscribe so you don't miss the next episode. Until next time.